How do banks assess risk for unsecured personal loans? Imagine trying to lend money without holding any collateral in your hand. That's what banks and credit unions do when they offer unsecured personal loans. They have to be very careful because if the borrower doesn't pay back, there's nothing to seize. So, how do they decide if a person is likely to repay or not? Let's walk through their process. First, they look at the borrower's credit history. This is a record of how well someone has managed borrowing in the past. They check the credit report, which shows all previous loans, credit card use, and payment habits. A high credit score means responsible borrowing and makes the bank more comfortable. A low score suggests higher risk, which might lead to higher interest rates or even a denial. Next, they examine income and employment status. Banks want to see steady income that shows the borrower can make monthly payments. They verify income through pay stubs, tax documents, or direct contact with the employer. If someone is self-employed, they might need to provide additional proof like bank statements or business tax returns. They also calculate the debt-to-income ratio. This compares monthly debt payments to monthly income. A lower ratio means the borrower has more room to handle new payments. For example, if someone earns $1,000 a month and pays $1,000 toward debts, their debt-to-income ratio is 25%. That's generally seen as manageable. The size of the loan and how long the borrower plans to take to pay it back also matter. Smaller loans with shorter repayment periods are less risky. For instance, a $5,000 loan paid back in 2 years is less risky than a $20,000 loan over 10 years. Lenders might also look at savings and other assets to see if the borrower has a financial cushion. Many banks use scoring models. These are tools that assign points based on credit history, income, debt levels, and other factors. The total score helps the bank decide whether to approve the loan and at what interest rate. A higher score usually means a better chance of approval and lower rates. After the initial approval, banks keep an eye on the borrower's payment behavior. They monitor if payments are made on time and may adjust terms if the borrower's financial situation changes. This ongoing review helps manage the risk over the life of the loan. When someone applies for an unsecured personal loan, they fill out an application, submit documents, and undergo a credit check. The bank then uses all this information to decide if the loan is a good risk. If approved, the borrower gets the money, but if not, they might be offered a smaller amount or a higher interest rate. Banks want to grow their loan portfolios but also need to avoid too many defaults. That's why they set strict policies based on their experience, market conditions, and regulations. These policies help them decide who qualifies for a loan and at what terms. In the end, assessing risk for unsecured personal loans is about gathering as much accurate information as possible. It's a careful balance of understanding the borrower's past behavior, current financial situation, and future ability to pay. This process helps banks make smart lending choices that protect their business while offering loans to those who truly need them.